Hi, this is Stephen here from Share Navigator. It's October the 20th, and this is your futures and options trade update. So first up, we're going to look at our SPY trade that expired on Friday. Then we're going to look at our existing short put option contract on our crude oil December contracts. And then we're going to look at a potential long call trade on crude oil. So we're going to discuss all of those and give you a little bit of educational content right at the end, comparing calls to puts. So let's get started straight away. For people who are new, it's always good to see, well, what does it look like when a trade expires, for example. So we go to trade and we look at our trades from last Friday. And you're going to see our SPY trade here. It's our 620 put. It says it's expired here. And you can see the price is zero. So it literally just disappears from your account. It's as simple as that. You've nothing to do. So anytime an option is out of the money, in other words, it has no value in it, at expiry, it just disappears from your account. There's nothing to do. When it's in the money, it's automatically assigned, whichever the case may be. Okay, so we just thought we'd say that's it. Just a summary on that trade. That was the short put leg of a three-legged trade. That was a bear put spread that was financed by this short put. The short put basically paid for the bear's put spread, gave us a small bit of a credit in it. The market didn't move down like we wanted. We only made $35 a contract, but it's still a great example of how to short the market in a more efficient manner with a lower risk of losing. That's the benefit of options, okay? Looking at our existing portfolio, you can see our crude oil futures contract is down. The short put on it is down. We're down $78 at the moment. So this contract, again, for people who don't understand what it is, we sold the $55 put option on the December crude oil futures contracts. And what that means is that we basically insured the value of the December crude oil futures contract to the value of $55. When we placed the trade, crude oil was trading about $60. Since then, it has fallen to $57. And that's why we're down slightly, because the value of the contract has actually gone up. We took in just under $490 when we placed it. That's why there's a minus figure beside it, by the way, folks. We sold the put option. We don't own it. And the current market value is $559. So we're obviously down by the differential between them. And that's because crude oil has moved down. But that highlights the beauty of the short put strategy. Just think about it. The value of the asset has gone down. We basically provided an insurance policy. If we'd have bought the stock outright then, or in this case, the crude oil futures contracts, we'd be down a lot more. And when you're writing the puts out of the money like we do, we benefit if the share price goes up, goes sideways, or goes down, but as long as it doesn't go down too much. So we don't see anything to do with this trade. We actually quite like it, to be honest. And it expires on Wednesday week, and we'd be still confident we're going to make about $490 profit on that trade. So we're not going to do anything with that, okay? What I want to share with you now is maybe there's a possible another trade for people who are interested in crude oil. So we're going to look at the call side of things now, but we're going to look at the micro version of crude oil. And the reason for that is the micro version of the crude oil futures contracts, it's smaller, okay? So I want to give you a bit of educational context here as well, and just really to try and teach you along the way as to what you should be looking at when you're trading call options. So first things first, we're going out to January 14th, which is 86 days away from now. And that's for the February crude oil futures contract. So we're basically going long. We're going to buy a call option. And we're hoping that the value of crude oil goes up from here. It's currently at $57 a barrel, right? So the first thing is we look at the time frame. And the reason for that is a thing called theta. So if you look at this Greek here called theta, and you can see for call options, it's a minus figure. That's the value decay every day between now and expiry of the value of that option, just because one day is ticked past, for example. And when you are very close to expiry, so for example, 40 days away and lower, the value of theta goes up dramatically. And therefore, the value of your option is disintegrating at a much rapid rate. That's why we like a longer time frame for things to work out, number one. And for number two, and more importantly, really, is to avoid this time decay as much as is possible. Okay, so we're going to 86 days. The next thing you need to look for is your delta. So delta is how much does the value of a call option go up or down for a $1 move in the underlying asset. So in this case, it's the crude oil futures contract. We're looking at the 52.50 strike here. And you can see the delta is 0.7. So our rule of thumb is in and around 0.7 is what you want to be looking for. Your options are going to be slightly more expensive when you do it this way, but you're giving yourself a better chance of making a profit when you do it, okay? And you can see here the cost of this is going to be 625 roughly a contract. So if I just click on the ask price there, show you what the trade looks like over here. You can see, first of all, our maximum loss in this trade is $618. So when you're trading something as volatile as crude oil, knowing exactly what you can lose in advance is actually quite good. It's nice to know it. We can see our break-even price is 58.74. So what that means is we need crude oil on January the 14th to be trading above 58.74. So if you feel that's going to happen, this could be a good trade for you. And you can see our maximum return here is what they call unlimited. In other words, if crude oil keeps going up and up and up between now and January the 14th, we can make as much money as where the share price goes. I think a realistic target would probably be somewhere between $65 and $70 between now and January. And if that does happen, we're going to make anywhere between $700 and $1,200 profit on this particular trade, if and when we place it. Now, we're not going to place it now because we already have the short put out, okay? So we're going to let that trade play out a little bit longer before we go to this trade, but I just want to line up this trade for you. So finally, just to kind of highlight the differences between kind of the short put strategy, which is a bullish strategy, and the long call strategy, which is also bullish, is your probabilities. If you look at here, the long call strategy, your probability is only 42%. And the reason for that is the value of crude oil has to go up from where it is today to 58.74 in order just to break even. So in other words, it has to move up and then a bit more for you to make a profit on the call option. And the reason for that is the time value you're paying in your call option. That's the downside. That's this theta effect we're talking about, okay? So that's why your probability of profit is 42%. Now, what would happen here, for example, if we went over to the put side and we sold the 52.50 put for the exact same contract? Look what our probability of profit is. It's 77%. And look at the reason why our break even is $50.63. So you can see here, crude oil could actually fall from where it is now at 57, roughly another $6.50, 10%, let's call it, or more, 12%, before we would start to lose on January the 14th, okay? Now, the downside of this one, look at our maximum return. It's limited to 185. So that's all we can make, which is the premium you took in. Remember, when you sell a put option, you're ultimately selling an insurance policy, okay? And here's the biggie. It's the max loss. And this is the reason why we're going for the micro contract to make the options cheaper. Now, if you have bigger accounts, you can go for the main contract, okay? But, you know, if crude oil went to zero, which will be unlikely, we could lose basically $5,000 a contract. So that's a highly improbable scenario, but you have to be given it as well. So there's the kind of the pros and cons of the call versus the put. This is my preferred strategy because I like putting the odds in my favor. Having said that, when an asset gets very low, like where crude oil is now, if crude oil does tip down to $55 a barrel, I will be inclined to start buying the call options on it and going out 3 months, because I do think there's a good chance we could make a decent return on that. Okay, this is Stephen from Share Navigator. This is your options and futures trade update. If you've liked what you're seeing, please like and share the video. Okay, thanks and bye for now.